Using the wrong company or wrong product is bad, but an agent not proficient, worse. In this episode, I'm going to address the question that I've been asked numerous times: how to compare insurance companies. And as I show you ways that you can do this, it's not so much the insurance company or the product, even though it's very, very important. It's the proficiency of the agent that is designing the insurance policy based upon your objectives. So I'm Doug Andrew. I'm here in my radio studio. I have produced a weekly radio show broadcast nationally now for 12 years. And prior to that, I began writing books at the turn of the century, and I've written 11 books so far. We were so blessed in 2007. That book was the fourth one I wrote. It was written to an audience of 78 million baby boomers in this country that were going to outlive their money if they kept their money in the market, because many baby boomers saw their nest eggs dwindle in value by 40% after 9/11, 2001 to 2003. None of our clients lost anything. They actually doubled their money from 2000 to 2007. And then in 2008, as Warren Buffett put it, when the tide went out, he said it revealed who was swimming naked. A lot of people lost 40% again for the second time in a decade, and it took until 2012 to make back what they lost. Many of our clients tripled their money by 2012. $1 million in the year 2000, without adding a dime to it, had tripled to $3 million, whereas most Americans were barely back to break even. It was more a function of how we designed and structured their insurance policies rather than the company. Having said that, I'm going to share with you, I am very, very picky on which insurance companies I put my money. So let me share with you the criteria I use to choose the right company, the right product, but it's really, most importantly, the way it's designed correctly and funded properly. And I'm going to give you some horror stories to understand this. So when I broadcast my weekly radio show here, I'm usually limited to about 12-minute segments where I can't explain everything, and that's about all I have here. But I want you to click on the link below, and I'm going to gift you a free copy of my most recent best-selling book, The Laser Fund. It has over 300 pages of charts, graphs, and explanations, 62 actual client stories. I'll pay for the book. It retails for $20. I'll buy the book. You contribute $5.95 towards the shipping and handling, and I'll send out a copy of the book to you for free, and you can learn more. But let me share with you why and how you can compare insurance companies, products, and then how to fund it correctly. So when I'm looking for an insurance company, I want to make sure the company is strong, and so you want to make sure they have high ratings. What I do is I look at the various ratings that an insurance company has, such as the Standard & Poor's rating, or Moody's, or Duff & Phelps, Weiss, the Comdex score. See, if that's confusing, I like the Comdex score, and that simply takes all of the ratings and assigns a company a score between 1 and 100. I usually put my serious cash into insurance companies ranked 90 or higher on the Comdex score, which means that 90% of insurance companies are rated less strong or whatever than the one I choose. And so I'm in the top 10%. Now, frankly, I only put money into legal reserve insurance companies. That's the vast bulk of companies. It means insurance companies that have to have reserves on hand that are liquid and safe in case of a disaster in the economy or a run on the bank. And so that's why insurance companies, legal reserve insurance companies, have never not honored a legitimate claim. They cross-insure each other. If one were to become insolvent, all the other insurance companies licensed in the state where you live have to ante up their pro rata share of the percent of insurance. And that's why there's never been an insurance company not honor a legitimate claim. They cross-insure each other, whereas banks, credit unions, they pay a premium to the federal government for FDIC, Federal Deposit Insurance Corporation. And there's been times FDIC has been broke when we've had a run on the banks. But you know, government, they know they can tax us, they know they can print money. And so people feel fairly secure. But do you know where banks, credit unions, many brokerage firms put 30 to 40% of their tier 1 assets for liquidity and safety? Into insurance companies, okay? Many banks borrow our money and pay us 1% interest, and they turn around and they put it into insurance companies and earn 5%. Every million, they pay $10,000 a year in interest, and they make $50,000. That's 5 times. That's 500% returns. You can do that. But see, most insurance companies are ranked 6 notches higher in safety than the banks and credit unions. Many of them are only rated triple B. Most insurance companies where I put my money are rated triple A. That's like 6 notches higher in safety. So you can choose companies based upon those rankings. And so out of all the companies, and there's several thousand in America, there are only a couple of hundred that offer indexed universal life. And out of all of those, I only put my money in maybe 6 because I'm extremely picky on where I put my money. I want it to go into an insurance company where they are benefiting the policyholders more than their pocket. They are extremely generous in their rates of return. They keep a very small portion of the profits for them. If they're out there earning, like I did in the 1980s, they were earning 11 and paying me 10. They were earning 15 and paying me 14. See, they were only using one of the percentage points for them. And lately, with interest rates at a 50-year low, if I'm earning 6% in the insurance policy, they only use one of those percentage points still, and I net 5. But I can link it to an index, and they're able to credit me more like 8, 9, 10%, some years as high as 25%, and it's tax-free. So it's how you structure it, but only about a half a dozen companies do I really like the product. So you choose the right company based on strength and so forth, and make sure they're generous. Number 2, you want to choose the right product. But let me tell you the horror stories. I have had people who came to me and they said, Doug, we read one of your books, 10 years ago. So we wanted to set up an indexed universal life policy, but we have a nephew or we have a brother-in-law who is licensed. And so we went to them and they said, oh, I can do that. And then we heard you on the radio say, well, it's been another 7 years. If you put $500,000 into your indexed universal life, that $500,000 should be worth $1 million now 7 years later. It should have doubled. Doug, ours didn't double. We put in $500,000 and it's only worth $250,000. It should have been worth $1 million. Where's the other $750,000? And I go, well, let me see. And I sit down and I flip through. It takes me about 30 seconds. And I look at their policy and I go, yeah, you used the company, one of the companies I use. In fact, you use the right product, but who set this up? And they go, our nephew, he had a license. I go, oh my heavens, he had no clue what he was doing. You may have been earning gross 10%, but you only netted 1%, and that was gobbling up, the cost of the insurance was gobbling it up. He had no clue, or she had no clue what they were doing. That was an expensive relationship with your nephew just because they had a license. So I have found the vast majority of people that have non-performing indexed universal life insurance policies or any kind of life insurance, it's because the advisor is not proficient for that reason. To separate the sheep from the goats, back in 2007 and 2008, I designed a proficiency exam. It's a 100-question exam and 30 additional questions essay. To be honest with you, most insurance agents, most advisors that you see on TV and so forth, they wouldn't even score 30% on this exam because they're not taught these things. They wouldn't even understand the questions about TEFRA, DEFRA, and TEMRA. I can stump them in less than 60 seconds with my questions. And so if you've never been taught, how can you answer a question that you don't even understand? Now, isn't that something? And so one of the things that I've done in my most recent book is I have a chapter in here that has 14 questions that you should ask a financial advisor, an insurance agent, and if they can't answer these 14 questions right off the cuff without having to say, I don't know, but I'll check it out. If they say that, that's a warning sign. So you want to make sure the advisor is proficient. that they set it up so that if you earn 10, you'll net 9. If you earn 11, you'll net 10. So that the cost of insurance is as low as possible, and that if you put in 100,000, 500,000, a million, it will double every 7 to 10 years. And then when you retire, every million can generate 70, 80, 90, 100,000 a year of tax-free income. If it's not designed correctly, good luck. You may earn 10%, but you'll only net 3 or 4%, maybe at best. My heavens, that's huge. And so when people say, how do I compare life insurance companies? I can show you how to compare companies based on strength and everything else, but I can have you choose the right company. You can even choose the right product. But if the advisor doesn't know what they're doing, you're doomed, okay? It will not perform. So make sure you don't make that mistake. You can see if the advisor is proficient and is designing it correctly. We can look at that and tell you. We can audit your insurance policy to see if it was designed right. But I would recommend you read the book. So go to laserfund.com and claim your free copy. This is a 300-page book. It retails for $20. Now, I will gift you one copy absolutely free. To claim your free copy, you contribute $5.95 towards the shipping and handling. It costs usually a little bit more than that. And I will send out a copy of the book free. I'll buy the book, you contribute $5.95 towards the shipping and handling. It has 300 pages of charts, graphs, explanations, and actually 62 actual client stories. There is usually one story for every chapter of how it didn't work, and almost every time, it's because it wasn't set up correctly by the advisor. So don't make that mistake. Learn, get your free copy of the book, see how you can choose the right company, the right product, but most importantly, determine if the advisor knows what they're doing. If they don't, we can point you to an advisor who I am confident knows what they're doing.